Funding for the Stoller Report is made possible by a grant from the First American Title Insurance Company of New York. The First American Corporation is the nation's leading diversified provider of business information products and services that impact the major events of people's lives.
Hello, my name is Michael Stoller, the host of the Stoller Report, Real Estate Trends in the Tri-State Region. The topic of today's program is the state of commercial office buildings in the Tri-State Region, Industry Leaders' Perspectives. My guests include Steve Cantor, Global Head of Real Estate at Credit Suisse First Boston, Robert Lapidus, President with L&L Acquisitions, Leslie Wollman Himmel, a partner and a managing director at Himmel Merengoff Properties, Eric Hadar, President of Allied Partners, Anthony Malkin, President of W&M Properties, and last but definitely not least, David Browse, Vice President of Browse Realty, Inc. Thank you all for coming this evening. And I'd like to, prior to the show, we all met and we were talking about the insane prices and the amount of money that there's out there to buy real estate. In today's Wall Street Journal, there was an article saying that values of real estate are dropping. Office values are dropping. Why? And as you remember, as we discussed prior to the show, everyone's supposed to answer the question: why are values increasing so much in New York? Why are people paying such high prices? Mr. Hadar, especially since you're buying a property and you're hopefully closing this week.
Well, I think that real estate has over the last decade, let's just say, has assumed a position of a legitimate and respectable asset class, which has needed to make up for many lost years of time, and people are finally allocating significant percentages of their either institutional or individual portfolios to the ownership of real estate. So that's been a big boost to the real estate market on the one hand. On the other hand, we're finally reaching a point where I think everybody's reconciled to the fact that short-term rates are on the rise. The forward futures curve on LIBOR, which is a commonly used index of floating rate debt, is expected to increase 150 or 200 basis points over the next year or so.
So you're saying now is the time to buy?
Well, I'm saying that now is a difficult time to buy unless you're prepared to look at properties which can carry themselves with fixed rate, longer term debt. I think it's, what's driven the market of late is this ability to enjoy, above extraordinary cash flow as a result of taking advantage of short-term rates. And I think what we're seeing now is a little bit of an adjustment and a correction.
I don't necessarily buy into that. I read that Wall Street Journal article, and the bottom line is that they said values are dropping, but last time I checked, the Wall Street Journal reporter who wrote it doesn't buy and sell property. What it said was that residential...
That's why he's a reporter.
Residential rental properties are declining in performance, and office properties are declining in performance. But it doesn't necessarily follow that the values are decreasing. They were reporting on current operations.
And I think they were also reporting around the nation. Okay?
They were reporting on current operations, but they weren't talking about transaction prices.
Okay, but let's follow Steve, who happens to be the global head of all real estate transactions financing for one of the smaller lenders around Credit Suisse First Boston. How much money did you put out last year?
Close to $9 billion.
That's billion.
Billion domestically, okay. And we probably put out another couple of billion in Europe and Asia.
Okay, and of the $9 billion that you put out domestically, how much would you say that you put out in the tri-state region?
I'm going to guess probably in the $2 to $3 billion range.
$2 to $3 billion range, and that didn't include, since you didn't do You know, that little property with FAO Schwartz, which was sold for 1.4. So
We would have liked to have done that deal.
you would have liked it, but a lot of other people would have liked to also. Okay, but why are you so game to this marketplace?
I'm not sure we're so game. I think it's you got to look at we don't just finance $9 billion of real estate. We do a lot of work
No,
before
I
we
understand.
get there.
Right.
But I'm concerned about the market, to be quite honest with you. You know, I look at real estate. You know, return profiles have come down. So if you look before, and a guy owned a piece of real estate looking for a 20% return, he's no longer getting a 20% return.
Well, what we have to do, which we tried to discuss prior to the program this evening, since we're on the CUNY network, and a lot of people, let's try to get it down to the basics that people, you know, as opposed to a group of being at the real estate board for everyone over here, let's try to explain this.
I put up my cash. Forget the leverage, the debt I put on my property. I want a return on the money I put up.
Okay. It's like a passbook.
Exactly. Historically, the return on real estate, people were looking for a 20% return on a compounded basis if they bought a piece of real estate. Today, those returns have come way down. The reason is because return profiles for every investment have come down. Before, you can buy a tech company and hope to double your money in a week.
David tried to do that on his property in Long Island City.
Thank God we didn't.
Yeah,
That's right.
We can. So today, to get a hard asset that returns 12 to 15% return to the equity, to your dollars, is real important. People like those returns today. So the first thing that's occurred is since returns have come down, values have gone up. Secondly, real estate's been an arbitrage. What do I mean by an arbitrage? I've got to make money. I can leverage my money, and the total return, the dollars that I get out, have to have some profit to them. Well, what's happened in this market today is that there's been a high amount of leverage that has been used. And so today...
I mean, with leverage, you know, if we have to talk about leverage, the GM building, which is, you know, on the park for everyone on 59th Street, that was acquired by Harry Macklow in September. The purchase price was $1.4 billion, over $800 a square foot, and all they had in the deal was $50 million.
Well, there's other large buildings that have traded in other places, which I'd rather not discuss who, but same thing. They put up $50 million and controlled an asset well over $1 billion.
But to be fair, there was the sort of debt which Steve would put out, but then that sort of debt was covered on top of that by additional debt, unsecured or not with the same degree of security from Soros, from Vornado, right. and from a lender's perspective, you might as well look at that stuff as equity, more secure than your position. So Harry Macklow may have put in $50 million, but the actual dollars above the debt, the mortgage debt, were considerably more.
Right. I mean,
but those are the deals. I mean, let's step back. Those are the deals that, as a lender, concern me, because here's what goes on. If you kind of take that analysis, if you put up $50 million and you do it on a floating rate basis, because that's the only way you get an arbitrage today, because fixed rates doesn't get you there. Right. Okay, you're hoping that interest rates stay low so you can get your cash out in 2 years. If that doesn't happen, you've walked away, you've lost $50 million, or you've stayed in court for a couple of years trying to play with the lenders, trying to get your $50 million out.
Are you saying that New York owners try to stay in court?
Never. So reality is it's an interest rate play. Now, my concern is...
From Harry's perspective.
Well,
from anyone.
From any equity holder who puts $50 million up on $1.4 billion.
No, but Harry's also put a collateralization of that on top of the $50 million of many of his assets around Manhattan. So he's got more to lose.
No. I don't. We're not here to talk about that specific deal.
It's not a specific deal.
Okay. Right. Basically, Harry Macklow or XYZ buy this property, and there may be a total equity of $50 million in $1.4 billion property. Okay.
Let me do it a little differently.
Okay.
Okay, what's really happening in today's market is in the old days, people were borrowing 80% on the dollar. 80 cents on every dollar they were borrowing. So they put up 20% in cash, they borrowed 80 cents in cash. Today, that number is 90 to 95%. Through the advent of the mezzanine market or the preferred equity market, where returns today, people will invest in that market at about 12%. You could probably even do 10%, somewhere between 85 and 90. So those returns have come way down. So reality is that today you have a marketplace that people are borrowing 90 to 95% of real value. Now, let's define value. The concern I have as a lender is values today, I believe, they're high. I could be wrong, but I see that we're in the business of measuring risk. From a risk profile, my feeling is the risk of values going up, little or none. They could stay where they are for a while. I mean, New York is an island, if you want to talk about New York.
Right. It's 18 miles. You know, you can't go too much further.
Right. But let's talk about it outside of New York. Let's talk about it domestically in the U.S. What happens is if interest rates back up, and real estate is an arbitrage, cap rates will change. Cap rates being the multiple you pay for a piece of real estate. If that changes 50 basis points or a point, so if you're buying real estate at a 6 cap today and that goes to a 7, suddenly that 92% loan is 105%. There is no equity in the deal
Which is
anymore.
what we had in the early 90s. We've had, and that's when people took over the
That's
property.
my concern as a lender.
Yeah, but for the purpose of the consumer of this information, again, I don't think it's fair to focus on the $50 million because Soros made a calculated estimation that they would be happy owning it at their level.
That's right. But isn't it
and
true
Vornado made a calculated estimation that they'd be happy owning it at their level, and whoever made the senior loan felt there's no way I'm getting it back at my level. One hopes. So the equity, the headline of the equity, it's almost as though Macklowe put, or someone in that position, bought a hope certificate. They have an opportunity to control what's viewed to be an incredibly valuable piece of real estate. And other people, for better returns,
Right.
are prepared
I agree
to
with
own
that.
it for another level. And if they make their money, and Macklowe succeeds, they'll make their money, they'll go home. If he doesn't succeed, they'll get
can
away.
own it at a better basis.
But let's
Right.
also look at a situation. Besides being the president of W&M Properties, you're also the president of W&M Strategic Capital, or a mezz lender, or an interim lender, or somebody who's an opportunity fund. Okay, now I think reading in one of the website, you purchased or you provided some preferred equity or debt with Longview Associates on Herald Center.
Mm-hmm.
Okay. Basically, did you lend there to own to loan? Did you borrow? Are you lending the money to own that property one day?
No, I think that that was very simple. We looked at where we saw the performance of that property. As we
For
do
our
it-
audience, that's the corner right across the street from Macy's on 34th Street and Herald Center. The old Corvettes, which went through a number of gyrations. They had Toys R Us left. So now you have DMV, Staples, Daffy's, and a couple of other people over there.
The idea behind that transaction was, if the property did not succeed as we hoped, where would it fail? All right. The existing debt was above market. That's the first safety fuse. When we're going to refinance, we'll be able to refinance at a lower interest rate, number one. Number two, how much of our additional equity, which is what it was, are we going to be putting in? And the profile on that look was quite a lot. So it's not really, from our perspective, highly levered. Will we make an opportunity return? We think there's a good chance. But what's our downside? And that's what we look at.
Your downside is you can own the property.
Well, up to a certain return level, we do own the property. And above that return level, the person to whom we extended this facility
Has their piece.
has their piece. And as we look at every one of these mezz and structured equity positions from our perspective, it's what's our downside? All the way to, if we have to take this property over, what will our return be based on our underwriting, as well as what's the prospect of our making the return on which we're making the investment, i.e. the entrepreneur whom we're funding succeeds.
And we're glad he does that.
That's right. You're the primary lender, correct?
We're creating loans to sell. So we're looking exactly for people like that who want to own that piece of the capital structure.
And to turn it around, we got into this business because we couldn't buy property. So I had an option of saying, either I'm going to get involved in business up to the point at which I believe in value, or I'm going to be out of the business altogether.
Let's try to leave the lending side, and let's try to get to different parts of the city.
Can we just
Steve?
stay there for a
Sure.
second? Because that is really what has driven this market. The reality is the capital markets have been created that you can slice and dice a loan into enough pieces to find a buyer for each piece of that loan.
It's an old Zeckendorf pineapple structure.
Yep.
When William Zeckendorf Senior looked at the way he created different lease positions, different financing positions, it was the sum of the parts are worth more than the whole. I can find someone with a different profile for each piece, as opposed to finding one person at this price for the whole thing.
Right. You know, it's a risk reward. Certain people taking a different return for a reward.
And that's what's driven the market. The amount of capital available in his market, call it the 80 to 92, 93%.
What's a 97%?
But it's not. There's some equity in it. It's enormous. There is tons of dollars chasing those deals.
Right. And that's exactly where our bandwidth is. We started out as, let's say, actually 80 to 90, and we're really 85 to 93 now.
And that's the market.
And our returns, Fund 1, 16% overall returns.
And today?
Fund 3,
12?
11.5, 12.
Okay.
But investors like that return today.
That's
a hell of a return given the other things you can invest.
Okay,
in.
the market, but that's why I think what Eric was saying before is, people want to own assets. They want to own real estate. They look at the assets and they say real estate is a good investment.
The only part I differ is I wish people would take out long-term fixed-rate financing. I'm not seeing
that.
that.
Which Leslie last year did approximately, what, $80 million in refinancing of your buildings?
So I disagree with your statement before that everyone's borrowing 95%, because our company is like, we're trying to do real estate a little bit the old-fashioned way, where we own things for 15 and 20 and a 30-year horizon. Last year we took $100 million worth of debt and put on fixed rate 7-year money at about 5%. Not conduit, it was mainly savings banks. And our loan to value was about.
You don't like doing business with conduits? You don't like doing business with investment?
Done a lot. We have a few $100 million also with the conduits, but in terms of
renegotiating,
yeah,
that's exactly
right.
You should go to insurance companies.
Yeah.
You should go to savings banks. You should go to everyone. And make sure that
for the mortgage brokers.
That's exactly right. The mortgage broker and the lending.
But let's be honest, Leslie. What do you go to a conduit for? What do you go to a savings bank for, or to an institutional lender?
Well, savings banks, what we've really enjoyed with them is that it is doing business, again, as a relationship. And we've been able
flexibility. It's dealing with...
The documents I can get on a Thursday and honestly close on a Monday. The problem, and I don't want to put First Boston down because we like the conduits, we've had problems with the legal part of the conduit language, and we found that the non-recourse, recourse language goes way beyond what it really should be. And
if I had to explain conduit on my show,
right.
What I think we're saying is that people in today's market, and I think you definitely recommend they should go for a fixed rate loan, and which you've done, okay?
Right.
And which on one of your hats, because as the head of global real estate, I think I noticed that today you purchased a 75% interest in One Park Avenue, or an affiliate of CS First Boston. Purchased a 75% interest in this office building, which was owned by S.L. Green. And the loan that was put on the property was not a floating rate loan, was a 5.85, 10% fixed rate loan. So you practice what you preach, okay?
Well, you can't, fixed rate loans are not a panacea for everything. For something like that.
Wait, you bought a building, you just bought a building at 261 Fifth Avenue.
Okay.
Okay, did you do a fixed rate or a
floating rate?
Why'd you do a floating rate loan?
I'll explain to you exactly why. Why you do a fixed rate loan at One Park, long-term leases in place, your ultimate buyer of the equity was a German syndication. They want their coupon over in Germany, they want it secure, they want their 6-7% return, whatever it is. And the building is quote-unquote stable. I think when you're buying a building that's a repositioning, you're changing it from one phase to another phase, you're changing the tenancy, then it makes more sense to do a floating rate loan until you've stabilized the value and then put on a fixed rate loan. That's why at 261 Fifth we put on a floating rate loan. There are things we want to do to the building and improve the bottom line.
The owner of 261 Fifth was a German entity?
The owner of 261
KBS?
Fifth was the state of Michigan, advised by KBS, was a pension fund advisor. They had bought that building with another building, part of the IDA portfolio years before, and they made a very good return. The thing about our business, sometimes it's a good time. There are buyers and sellers in our market, just like in the stock market. And because I want to buy something doesn't mean I'm making a good decision or bad decision for the person who wants to sell it. They had their agenda. They bought it at X. They held it for Y period of time. They made a certain amount of money. Time to exit. It's always a good thing in our business. Everyone here will tell you it's great to make a profit and to realize a profit, not on paper saying, gee, I bought this building for $1.
I mean, it's not like the stock market that you're looking today that it's up over here.
Sometimes it's important to capture some of that value. What S.L. Green and SITQ did at One Park, by retaining a 25% interest, valuing the property at a much higher level, taking out a big chunk of profit, and still operating the property and getting the income stream and the fees, that's perfect. Correct. We did the same thing at 155th Avenue with the German syndication. Same type of thing.
But if I want to just go to Anthony over here, under the W&H properties, okay, which were the Ween and Hemsley, the Harry Hemsley property, you're doing something like what David is doing at 261. You take the Lincoln building, which if you went into the property 2 years ago, it looked like a dump. Okay, it may have been a great location. We have to be realistic.
Right.
The building had some
It's
negative.
your show. You can be what you wish.
No. It is my show, but everyone, as you know, has their opportunity to say their comments.
I thought it was a nice building.
It needed some renovation.
It's better now.
Yeah, I would definitely agree that there was a value realization opportunity.
Right, and as opposed to getting one of these large tenants, going to 300 Madison, where you have these large block of spaces, you have a lot of law firms. You always had a lot of law firms over there, but you put different types. Okay, you've made it more of a boutique building, or
I'd say that building's in the middle of a transformation, and I would say that what we are doing there, candidly, we would be doing regardless of any market environment. It was a matter of a transition in managing agent. It was a matter of really deciding to tee the building up to what it could be. And our deals in general have extremely low leverage. And therefore, we're
on
always
your deals, are you a fixed rate borrower or a floating rate?
We are 9.5 times out of 10, we're a fixed rate borrower. And in the case of the renovation of the Lincoln building, in order to draw
Lincoln
down
building is
60 East 42nd Street,
right across the street from Grand Central.
1,200,000 square feet, acquired by my grandfather in 1954 on behalf of a syndicate. And that's a building wherein the program you're discussing, renovating the lobby, new elevator cabs, new hallways, new bathrooms, new windows, new systems, top to bottom, new security system with turnstiles and the like. The idea there is we don't know over the 30-month period of our improvement program how much money we're ultimately going to borrow. Because if the market stays the way it is today, tenant installation, free rent, things we'll have to put into each space,
Brokerage commissions, right.
That could vary. Well, brokerage commissions will change if rents go up, they'll increase. But if the market improves, free rent will be less, tenant installation allowance will be less, we'll borrow less. So when we borrow against a line established by the institution from whom we borrow. And when we decide that we wish to, we have the right to lock over long term, over the life of the remaining lease at a fixed rate, however much we've borrowed up to that point. So we maintain the flexibility because we may not borrow the full amount of the facility with which we're working. In general, we're at a low point. Interest rates could go up another 150 basis points, 1.5%, and we'd still be at a low point historically for interest rates. At 7.5% all in, you're at a low point for interest rates. So
aren't we at the lowest interest rates, Steve,
40
in 20 years?
Yes.
20 to
more
25
More
years?
than 20.
Okay.
40 years.
40
Yeah.
So we'll do that, and we won't float because we have the luxury of not floating. If you're buying today and you're locking in, then you've also got to have the luxury on the other side of patient equity money prepared to take a lower return.
Okay.
But how do you, if you're borrowing today, if you're buying today, it's 6 caps, which in the city it's not unheard of today. People are selling buildings at
That's
6
correct.
caps.
On NOI.
Okay.
Right.
On net
35th
operating
just traded at 5.58.
Before CapEx.
How, if you use any leverage, if you can use fixed rate leverage, it's dilutive.
Right.
Exactly
Absolutely.
right. So if you're going to use any leverage, it has to be floating.
Well, or
No. I disagree. Yeah. I mean, we actually last year bought 360 Lex around the corner from you, and Morgan Stanley gave us a conduit loan at 5.5%.
Okay, what was the cap rate on the property?
It was about a 6.5%. We put in a huge slug of equity.
Did you get fixed rate, did you say?
Fixed rate, yeah, fixed rate. And there, because we really believe in creating value in long-term ownership.
Where's the value creation there when you're getting 100 basis points on your debt and you're putting in so much equity?
Okay,
what kind of return?
Because you're gonna goose
Wait,
your
we're
operations.
in investment banking, and we thank you for all the wonderful conduit business that was established, because before 1992 we didn't have a liquid conduit market. It's terrific that that was established. But as long-term owners, a lot of our properties we've had 10 and 15 and 20 years. We don't look at it from a day-to-day hit as to what you're making, but as to a 5 and 7 and a 10-year hold.
Okay, so help me out here. It's 5, 7, 10 years. You can't believe there's a lot of cap rate appreciation here, can you?
Oh, yes, because
You believe cap rates are going to get better than they are today?
I think you're doing opportunistic purchases, and you're buying where your average rent at 360, our average
But that's not
rent.
a cap rate change. That's a change of cash flow.
Right, but that's what you're buying.
So
that's
let's
what
talk about the
you're buying
building.
for.
What kind of upside did you see in the cash flow there? Because it's not a
Average
cap
rent
rate.
was $24 to $26 face gross rent, and today we're probably getting mid 30s. A few years ago they were getting 40, 42. So there's probably $20 gross spread, so that the net operating income, long run potential, can go from an initial, let's say 6.5 to 7% cash on cash return, up to let's say 14 to 20% cash on cash return for a long-term hold. It doesn't work in the short run, so I agree
you
with you.
believe
on
that
the spreads.
cap rates will stay where they are and underlying cash flows will improve?
I think that in certain...
I think what you're saying on a case-by-case basis, not overall, as a market statement.
Let's assume cap rates.
Cap rates will rise, first
Let's
of all.
assume cap rates rise, but still you're looking at the arbitrage of an owner-operator who's not going into a stable property.
How much of that are you giving back in value, right? You got to look at two things, cash flow and cap rates. $20, how much do cap rates have to move where you basically gave that profit back if you went to sell the building 20 years from now? Doesn't matter. Time frame doesn't matter, right?
But I think you're raising, by the way, a surprisingly observant point for someone who generates
$9
mortgage debt to be sold in the public markets.
That's why we have him on the show. We didn't bring
which is that there's no question that my grandfather always used to say, in a high interest rate environment, borrow as much as you can while it still makes sense. But in a low interest rate environment, borrow very conservatively as far as total amount, because if you don't, you run the serious risk of losing the equity buildup that you've made on a refinancing.
But I'm asking a question differently, which is, if you're buying assets at 6 caps, pretty close, okay, you can't tell me sitting here today that you don't believe that is close to as high as you're going to have to pay for a piece of property.
From a cap rate perspective.
So if interest, so let's play it out. If cash flow is going to improve from $22 to $40, theoretically the economy is doing better. Theoretically, interest rates will move up. Okay. Also theoretically, cap rates will get worse, or multiples will come down.
Right.
Correct?
Right, but the part of the
You're
equation...
giving part of the upside back in terms of that.
No, of course, because you're looking at it from the pure financial engineering, and you're right on that. However, the creation of value comes from the delta, or the change in the increase in what you've created from a lower rental value to a higher rental value. And the $6.5 million cash flow that we had as an example, 360 Lex, when we market to market in time and we're patient, we will be able to get that to like an $11 or $12 million.
Simplistically asked, if cap rates went from your 6 where you bought it to 9, what does that do to your pro formas 5 years out, 7 years out, 10 years out?
Cap rates won't go to 9 unless you're going to get a commensurate increase in rents and
Exactly.
inflation.
That's my point. She just went from 22 to 44.
Well, right, but you're going to get that. And your value will be 80 to 100 million.
You can't be sitting here today believing that there's not a big subtenant market here. There's a lot of empty space in Manhattan.
You know what?
But
prior to dinner,
you raise a very interesting point, because I'll throw something else in here just for the mix, all right? There is a whole other school of thought, which is if your interest rates are going that high, if your cap rates are going that high,
your rents are going to go that high.
Not only your rent's going that high, but inflation is kicked in.
Right.
Sure.
So the dollars that you're going to have to refinance in the future are far less expensive than the dollars you borrowed today. So you're going to have you're going to be looking at an increase in value. One of the beauties to, of course, fixed rate debt is you have an opportunity to borrow today, and if you have inflation over 10, 15 years, compounding, instead of paying back $1, you're going to pay back 80 cents.
Right.
Now, by the way, we're not buying today, unless we get a very good return out of the box, and we really have only signed a contract on new property twice in the last 2 years.
Right. One was the French building.
Well, it was a combined package with Jeffrey File and Lloyd Goldman of the Fred F. French building and
Which is
10
for our
South LaSalle.
audience, which is 551
551 Fifth, and something else we did in Chicago
Okay,
recently.
fine. But
But understand, every property
New
is
York
well
show.
bid today. Just assume you're the high
Right.
bidder when you buy it.
There's no question, and the flows of
Which is
capital.
what-
Right.
what
The flows,
Robert
of, the
said
flows
was-
of capital we haven't discussed either, which is it's not just debt capital that's available, but equity capital is at an all-time high.
Absolutely.
So the fungibility of real estate, the liquidity in the real estate markets,
Okay.
is at an
Right.
absurdly high.
Team,
That's correct.
We've spoken about cap rates. I want to try to get to some properties. Okay, I want to talk about what's happening so our audience can get an idea. We just brought up the point that Anthony was repositioning or renovating your property at the Lincoln Building, also at the Fisk Building. David had a property. The family has owned the property since 1980 in Long Island City.
Right.
And 2 months ago on the show, the topic of the show was Long Island City. And the interesting situation on Long Island City was looking at some of the past history. In 1998, there was a dot-com world. And Browse Realty and possibly Leslie, who had a property, still owns a property in Long Island City, everybody was going to have fiber optics and everyone was going to have dot-com. And you were, it was,
Connectivity.
okay, it was connectivity, and it was, at that time you were calling it the Bridge
Bridge
Tech.
Plaza Tech Center. It
Bridge
was a
Plaza.
400,000 square foot building right at the foot
Originally
of
a
the Queensboro
buggy
Bridge.
house?
Originally the Brewster Carriage Factory. They built the carriages, and then they built Rolls-Royce chassis for the automobiles, then airplanes. I mean, this is a real nuts and bolts concrete blockhouse right at the base of the Queensboro Bridge. But you had great fiber, you had great connectivity. We could put
Great
armies
subways.
of 8 subway lines right to Queens Plaza, and you had the right nexus of events happening, that high rents in Manhattan, great subsidies from New York City, New York State, great tax benefits.
Properties like 360 that were renting for $45
Absolutely.
a foot at that time, which was overpriced.
So MetLife
Okay.
hit the arbitrage of leasing to CS First Boston for in the $55, $60
So
range at One
MetLife,
Madison.
okay, which was something prior to dinner, we said, who's going to move? Who's going to move their corporate headquarters to Long Island City?
MetLife moved their
Well, no, Citigroup never really moved their corporate
corporate back
headquarters.
office.
That's true.
Okay,
That was
City,
back
that was
office.
only back office.
Absolutely
and
right.
it was
That's
also it was a self-contained location.
As J.P.
okay?
Morgan moved to Metrotech was back office as well.
That's right.
So you really haven't
but
seen.
MetLife,
Right, MetLife was really the first example of a major Fortune 500 company coming to Long Island City, or really any of the outer boroughs, for a real corporate headquarters.
is everybody there?
Everybody's moved in. So you've got the boardroom of the company, which will be staying at 200 Park Avenue, but all of the people will be out in Long Island City. They did a demographic study of where their people are coming from, commuting every day. 70% of the people were coming from Queens, Brooklyn, Long Island, Bronx, and they actually had quicker commutes to our building.
Do they have any vans taking their employees to Long Island
It's all
City?
subway. You've got
It's all
8 subway lines. You're very easy to get to New Jersey Transit at Penn Station. Long Island Railroad comes right through Long Island City, Metro North to
And
Grand
they love the
Central.
property so much that in addition to the 414,000 square feet that you own, you then built them in addition, so they're at about
They
600.
exercised an option for us to build an extra 300,000 square feet adjacent, so you walked right through from old
And maybe
building
they
to
could
new
have built
building.
the stadium not too far away.
That'd be great. That'd be great.
Okay.
But what's happening in Long Island City is it is amazing what's happening in Long Island City. You've got the Olympic Village that everybody's now focused on, which would be right at the Queens West site run on the East River. You hopefully will have what happens in Long Island City, what happened in Hoboken, Jersey City, Newport, also what happened in Metrotech. But now finally,
But you know, the question of Metrotech was also that we did try to discuss before the show. Metrotech, Jerry Cohn, who was on the show in Long Island City, was probably the biggest broker representing Ratner and a variety of other tenants, owners who moved to Metrotech. And he said people went to Metrotech besides the incentives, which you had in Long Island City, and other reasons. They went there because it was the proximity to Wall Street.
right, I saw that show.
Okay.
He was right. And he
Okay.
looked at downtown Manhattan, and then he looked at Brooklyn on one side, he looked at New Jersey on the other side. What we have in Long Island City, and Leslie has in Long Island City, is Midtown. And as great as downtown is, it's not Midtown. And to be one stop away from Bloomingdale's and Midtown Manhattan, as Alan Suna remarked on that show, is a huge home run. And to have all of those people collecting right through Long Island City every day, and hopefully we have the Sunnyside rail yards that get developed. You've got Tishman Spire with Jerry Cohen leading to have a 4 million square foot mixed-use development right across the street from us. You're going to have enough density, population.
Okay, now I have sitting over here, okay, I have two basically active purchases, okay? In the last 2 or 3 years, you've acquired 4 properties.
Okay.
Okay, Eric, in the last 4 or 5 years, you've acquired 25 properties, okay? What about Long Island City?
We looked at Long Island City around the time, I guess.
Today.
Today?
Let's talk about Long Island City today.
Today, I am.
Because I'm going to ask Rob all the same thing.
Frankly, I'm not a buyer of Long Island City. And
But you are a buyer. You're going downtown. You're buying a building at 95 Wall District.
I'm buying a $30 billion infrastructure. Okay, I am buying into the theory that somehow, some way, between the feds, the state, the city, and the private equity that's going into that district within that 5 square miles is going to do something dramatic between now and 2010. That's my bet downtown.
Okay. And you, Rob?
I'm not a buyer today in Long Island City.
But you are a buyer in
No,
Midtown, but you're not a buyer downtown. You haven't bought
David
anything.
wasn't a buyer in Long Island City. He already owned it.
That's right.
That's right. We owned it. No, they bought an extra
We bought
property.
1980, but in 2000.
Anthony, we're going to go to Westchester in Connecticut in a little while.
I'll be a buyer.
And then we're
in
going to
Long
get some
Island
other
City.
boroughs.
Yeah,
I'll be a
well,
buyer in Long Island City at David's basis. Yeah, I mean that's.
Okay,
right.
wait, guys,
Oh,
I bought-
you mean
I
in
bought
1980?
Right.
Okay,
No,
1980.
Well, I'm saying, it's
2002
all about an
basis.
opportunity. I won't take such a broad brush and say I would never own Long Island City, I would never own downtown. There are selective pockets
you know what?
downtown that listen, I believe there is an historic opportunity to make downtown a much better place. It's not Midtown. I don't know if it ever will be Midtown, but if you're a long-term holder, if you can make a 20-year bet for downtown, I think there's some good assets that make some sense.
But let's ask our
to do
lender.
that.
Okay, our lender and also an investor because
Right.
of the CS. What's CS, in your opinion, of lending and owning in downtown today?
Well, I'm not an owner. I'm a
No. No, but CS First Boston also owns assets.
No, we don't own any assets.
They
DLJ
provide
Real
a
Estate
bridge
Capital
equity
Partners,
program.
we have bridge equity.
Okay, fine. Okay,
So we're no longer, we're not, CSFB is not a long-term holder.
Okay, so let's go to
Bridge equity
downtown.
is how you get to Long Island City.
Downtown,
That's a lot of equity in Long Island City. You're not
we'll
gonna get
lend
the loan.
anywhere. It's only a question of what cash flow you're lending against.
So
And
is
how
it
much you
cash
lend.
flow? Is it cash flow
I'm
or
a
is
cash
it
flow
credit
lender.
tenant?
I'm a cash flow lender.
So you don't care if the company has been davidbrowse.com with Lapidus over there.
Well, I care
okay?
about credit. And
Well,
the
that's a
cash
very
flow.
high credit then.
Look,
if it's
our
possible.
analysis,
That's a good
our
team.
analysis is simple. We'd rather lend when cash flows are low, right? I mean, the best day of our loan is the day we make it. It doesn't get any better than that. That's a par loan. So reality is,
The question that I have is that when you're looking at a yield and you're looking at the potential growth of that yield over time, and you're looking at downtown, and you're looking at midtown. Let's look at midtown. You've got a stabilized, really the definition of stabilized income-producing real estate. Downtown Manhattan, you're at $30 a foot. You can see it going to 40. You can see it going to 50. Versus looking at a yield in Greenpoint, Brooklyn, Long Island City, Queens. I mean, really up-and-coming areas where you're going to see multiples of growth.
but I'm a lender.
compared to midtown
I don't get
Manhattan.
that benefit,
Right.
so I don't really care.
Secure that cash
But the
flow.
comfort is there.
He's looking at
from
it.
an
He
equity.
can't look for the future.
I made
He has to
a
look
simple analysis in life. If there's high returns, there's high risk. It doesn't come without risk.
Right.
So if you're telling me there's a 50% return, I'll tell you I'm probably taking more risk if I'm making a loan. I'll probably make a more conservative loan.
Yeah, but I think in Long Island City, now we made a bet and we bought it ourselves in 1986, which is almost, I guess, almost 20
18
years.
years.
Yeah, 18 years, but almost 20 years ago. It's just like long-term hold. We've been waiting for Long Island City to happen and to change. And I think finally, I know Andrew Alper was at a conference that I was running today at the Real Estate Board. The city is behind helping the boroughs, particularly in the industrial zones, have a different cityscape so that we can compete very well with New Jersey. And so I think the EDC and Bloomberg's administration is really trying to back up rezoning and also changing even the cityscape with trees and parks and having a master plan. You know, and to that import, they're going to have a whole rezoning for industrial zones for the very important 500,000 person job base that we still have without superimposing that everything has to be an M12 zone. We have a property right near MoMA where many people may have visited in the last few years, and that's still, unfortunately, just zoned as at 2 times the lot. And there's many people who would build mixed use if the city gets behind it.
Zoning changes, people take time. Last month when we had Josh Muss and he was talking about his property in downtown Brooklyn, and he developed, and it said took them 17 years to develop. Right. You own this for 18 years, okay, and it may take you another 3 or 4 years before the zoning is changed.
Yeah, we don't have that long a view on what we do, and maybe that's because we have problems with vision. But we have always.
I don't think you have problems with vision.
We
WNM
and my view is shorter than yours.
Yeah, we look at things we'll look at redevelopment, but we're looking at basically buying inexpensively when there's an inefficiency in the marketplace.
And that's what you've been doing, you think, in Westchester and Connecticut today?
That's what we did, absolutely. Absolutely. If I've decided in real estate, if bringing up a market is like inviting people to tea on a leper boat, it's either really bad or really good.
Okay, so when you went into White Plains, and I think White Plains is a good example of maybe the leper boat.
People just couldn't. When we started buying in Fairfield County, there was a 21% overall market vacancy. When we went into Westchester County, there was a 24% overall market vacancy. People could not understand what we were doing there. Many lenders wouldn't even, even our relationship lenders wouldn't even talk to us. But you can look at.
You didn't call us.
Well, you're
1-800-CS First Boston.
I will keep that in mind. The fact is, however, that if you're in a market and you can actually see what other people can see, if there's an inefficiency in capital, in knowledge, or in execution, there's a great opportunity.
But I think.
Or by the way, it could be Des Moines. Bad idea. Don't go there.
It's interesting. What I've noticed around this table today, being the only lender here, is that each you find an opportunity in what you buy that someone else in this room didn't see. And so
there's a buyer and a seller.
And that's been the difference, right? So everybody's got a set of numbers, but someone's set of numbers is better, and that person theoretically pays the most money, and that's what's happened in the marketplace.
And when we have a vision problem when 530 Fifth Avenue goes up for sale. And I tell my guys if they want to work on it, they've got to underwrite it with potential spikes. They've got to, and I sit down at a meeting and they tell us what they've got. They tell me to where they've gotten the price, and then 2 days later we find out that the senior loan that's available is more than our total value of than how we value the property.
We looked at that building as well. Joe Moynihan ended up buying it. The yield that he bought it for
a consortium.
It's your point. It's lower than the debt. We look at these, and you look at the underwriting that the broker puts in.
You heard the response. The response was right there. 30. I saw something you didn't see. It's $20 long-term holder.
I think he sees a residential conversion.
Yeah, there's
that's the issue.
It depends so much on the capital involved in the deal, right? Certain capital. I mean, New York is a place where every type of capital is attracted. So we have the public, the private, the foreign. Sometimes there could be foreign capital that wants to come here. There's a whole play with the euro going on now. And some people in Europe have told me that if they buy an asset today and it doesn't change in value at all, the asset, over the year, they're going to make a 30% return because the way they value the currency game with the euro vis-a-vis the dollar.
But
there's always an agenda buyer here. And so when it goes auction, the investment sales brokers have done a great job in convincing sellers that they need to use a broker, and they send a book out to 100 of their best friends.
33 people bid on your property at 261. 95 wall, 25 people. 530, they were lined up at the door to buy it. Okay, people
so
want
it's a combination.
But you guys are outbidding
each other.
You're outbidding the German syndicators. So as much as their returns are quote, getting a 20% kick in currency, you guys are outbidding them.
By the way, they're backing off a little bit.
We're having a workout, okay? That's all that happens when we underwrite properties today. It's stick your head up out of the hole. What do you know? I got hit up with a head on a baseball bat again. Okay, go back in the hole.
It's also a different profile asset that they're looking at. They're not going to look at an asset that needs repositioning.
But let's talk about repositioning in a different manner. You just said maybe 530 Fifth Avenue, which is 44th Street and 5th, is going to be a play to make it a residential. And when we were walking here from our prior to the show, David was talking about a property that he owns on 32nd Street. And I said, directly across the street from a property that your syndicate family and everyone has owned, known as the Empire State Building for years, there used to be a White Castle, the famed Chinese food of Seinfeld, which our executive producer, my good friend from CUNY TV, Bob Isaacson, always enjoyed going to. And that entire block, okay, with the exception of the bagel store on one side and the other store, are all coming down. Okay? Somebody's buying that, and they're putting up a 35-story apartment house. Okay?
Go, baby, go. We need more of those. You know why?
But right behind your building, they put up this monstrosity, okay, on the parking lot.
We need more of those. Because if we don't get people to do really foolish things with their money, there'll be nothing for us to buy.
Well, no,
Okay.
these are condo developers, and they're looking at a whole different
They're
ball
on
games
Fifth
than the rental
Avenue,
guys are.
on Fifth Avenue,
Different set of
next to
numbers.
North Fork Bank on 37th Street. Okay, there were two schlock merchants. Okay, for years. Okay, you know the quick, buy T-shirts. Right over there, Trevor Davis and Joseph Chatreet, okay, are building another apartment house. Okay, I mean. There aren't any supermarkets nearby. Okay, there are a couple of green grocers over here, but
So they'll only get $1,100 a square foot as opposed to $1,400.
You know,
I mean,
we've
that's how nutty
done the
market
condo
is right now.
development biz, and you know, it's funny. When that thing shuts down, when that market shuts down,
Thank you.
It just
It's not,
stops.
it's not a 10% reduction
it just
in price.
stops.
It just
doesn't happen.
shuts its doors.
And I will never forget, I started out actually in the venture capital business, and when I was doing that, my father talked to me about a building up on Broadway and 72nd Street that we developed ultimately with the Stalls. We started out with Zeckendorf, Stahl, Cohen, and Comrest, and we ended
Ansonia?
up alone.
No, next to
the Alexandria.
The Alexandria. on the corner.
And he said, we've got this offer, someone else wants to buy the land, we've already got the plans, what should we do? I said, if it's built and it doesn't sell, will it work as a rental? He said, no. I said, sell. Well, it didn't. And we didn't. And fortunately, because of a retail lease, which is why we started to buy retail in Manhattan, we were able to sort out the whole workout. But the bottom line is, we sold 70% of that building like lightning, and then it stopped.
Right. The balance
and,
of
and the money
30%.
was in the last 5%. And there was a huge write down on that. I look at the people who are doing those deals, doing those condo deals, and I say, good for you. Good for you. Because if it works, you deserve the money you're making, and if it doesn't work, I'd love to get my hands on that retail or on those unsold units or whatever that might come out of the pike. Because when it doesn't work, the headlines are going to be real estate blows, run away. And that's when we can come in and hopefully try to buy something.
But that's who we're competing against. We're competing against a guy who can sell at $1,100. People are projecting $1,500,
Right,
and we're
but
projecting
When the
$30
office
rents,
building
$40
brokers
rents.
today are selling an office building, they say, oh, you got to look at the top of the building as a residential conversion. It might make no sense at all. The floor plans might not make any sense. It might not be a residential area, but they'll convince you that it's worth $1,000
Wait
a
a
foot
second.
to help you pay
But,
$500
we were
a
talking
foot.
about properties prior to the show down on Lafayette Street in Soho. I mean, these weren't neighborhoods 20 years ago. I mean,
Yeah, but
They
they
are
were
now.
cheap.
Yeah,
they
they were
were
cheap.
cheap.
okay.
And these deals are not
$100,000
cheap.
a floor. That's what the bogey was in the 70s for those old
So
loft buildings on
when
Lower Fifth.
Tony Goldman bought them, he bought them at those prices, is what you're saying.
That's right.
And what about people who are buying them today? Who's buying down in Soho today?
There's nothing left. I mean,
Okay,
most of it's been
but you know what? It
converted already.
relates to what Tony said. Okay, what happened in Soho was like 225 Lafayette Street, which was this building which was destitute, okay, for years, and now a developer has it.
It's
Okay,
got a subway running underneath it. You can't live in that building. The vibrations keep people up all
It's
night
the
long.
Manhattan
It's a-
Farm. They're going to get more
Tenant
for the
amenity. What are you
vibration.
talking about? It's like putting the nickels in the
Exactly.
bed.
They're going to people roll up
I think you've done
wait a
right.
second.
Super
That
8
building,
hotel.
they put 3 extra floors. He's a guest on next month's show. Don't talk that bad.
He's
When
gonna
I
do
asked
great.
him,
Listen,
no,
the
but I
great
think
thing about our
Anthony is
business
not a
there's a
great
lot of
secret.
people
That-
with different vision,
Yeah.
and people in our business, we're passionate about what we do. A lot of people have vision, and a lot of people have really the ability to take a risk. And when they make it, I mean, boy, do they make it. I mean, if could you imagine if the GM building 5 years from now is worth $2 billion? Everyone's going to say Harry stole it. Who knows? I don't know.
I think the question on that, if you read the article, it said that the rents for him to get the yield, the rents have to be over $100 a foot.
He just
Look
did a
what
$100
people said
deal
about
there.
RFR when they bought the Seagram's building. They
Right.
had Seagram's moving out. They said you got to get rents here of $100 a foot on the lower floors to replace Seagram's. They're
Wait a
crazy.
second. Now you bought a
They've got a
building. You
lot-
bought a building not too far away.
Yeah, but that was at a different cost structure. They needed to get a short-term loan. They were in LIBOR financing. They were
Oh,
losing.
you mean on the Citigroup building?
and on 375 Park Avenue on
Right.
the Seagram's building.
But on the building that you bought,
Right. We
with
had
the
the
Boston
base
Properties.
Right. We had the base locked up for 15 years with Citicorp on a new lease. So the only space we had coming due was the top 25 some odd
so you were
floors.
protected.
I felt so, and I felt that the only reason
and
I
I
was
think
even
Boston Properties felt so also.
yeah, and the only reason I was attracted to that opportunity, quite frankly, was I felt that the office rents couldn't possibly continue to escalate. And people in those days, and this is 2000 and 2001, were chasing office opportunities only that offered turnover.
Right,
where they
vacancy
could
was
take-
valuable then, and then
they
it
could
became a
take-
great asset, then it became a huge liability.
Correct.
And
And
it's
I
starting to
say-
become an asset again, I think.
Right, but you know,
And I
let's
think
talk
what's
about
interesting-
because for our guests who don't, for our audience who don't know, you own the property. One of my favorite stores. I was into the Tasmania Maniac. You know, the Warner store over there on
Right.
57th Street, which you
Owned.
You
We
owned,
bought.
You
We-
bought the
we bought
property.
and sold.
You bought
That's
and sold. Within a period of time, you bought it for about $55 million.
Right.
You sold it for what, $200 million?
A little more, right?
Okay, yeah.
Roughly, yes.
What's a $10 million to
Right.
friends or something?
But the
That's the
carrying,
good part
the
about
carrying
business.
costs were killing.
If interest was 20%,
Bugs
I think
and the other
I'd-
guys, the carrying costs were really. Now wait, but LVMH
Right.
bought it for what? Just for retail, or do they have any offices?
They
or-
have office condominiums, which they hope to be able to use, but frankly, we've had some discussions with them about maybe buying a condominium interest on the upper floors.
Right.
'cause
So,
they really
so
have
that
no
was the
use.
case of a buyer and seller. Here's somebody. You bought it.
Right.
Okay. You then sold it. These people bought it because they wanted top-notch retail, probably considered one of the best in the city on the corner of
Sure.
57th and 5th.
Sure.
Okay.
Absolutely.
And you know.
And I hold out to the theory that I wouldn't be at all surprised that if in 10 years from now, I look back on that sale and say, I should have kept the building.
Right.
I think what you've got here, Michael, is an interesting collection tonight, in my opinion. You've got Rob, you've got Leslie. We all here are long-term players. You've got a lender who's looking at exit cap rates, who's looking at 3,
He wants
4,
to make sure that
5
people
year.
are going to be able to pay him off later on.
course.
And we're
That's,
3, 4,
that's the
5 year
question. I think,
horizons.
and you know what? On all the shows that I've done this season, no one has ever gone to the lender, and we've had a couple of them, and I failed to say, how you lent this money, and what happens if it doesn't go to $40, like Leslie said, on 360, or on 261 where you bought the building or something else? What happens? You don't want to own it.
Nope.
Okay?
No, that's not their business.
Anthony said, that's why we're going to own it. We'll buy it from you. We'll buy that debt.
And that's what's changed in the marketplace. You go back to the last real estate depression, the lender was not a smart lender.
Right.
So he had to go through the workouts, and he was awful at it, and the equity took him to the cleaners even in the workout. Today, the lender is not your actual lender. What it really comes down is to the mezz and the preferred equity buyer. They're as smart real estate wise as the guy who's the equity. If it turns around and there's a workout, they're going to be tough guys to deal with.
And they're going to take
And
it
they're going to
over.
know
They're
exactly
gonna
what they're
buy the
doing,
property.
and they want to own that property,
Right.
and they'll be able to do a great job at it. So I think you made a great statement at the beginning. As the person who's selling, quote, conduit paper on the senior basis, a pooled bunch of conduit, my comfort level as the lender on a senior basis is there's guys like him sitting there who can operate a property and take it over, protecting the money of the senior lender.
But candidly, there are a lot of mezz players who are no one other than financial arbitrage folks. They're not real estate
pure
operators and
hedge
owners.
funds.
And we look forward to that too.
Right.
Yeah.
Right.
We look forward to real estate being
aren't we
tea
saying,
on the leopard
aren't we
boat.
saying that real estate has become a pretty efficient capital markets? That's been the big change in the last 10 years. You didn't have a REIT market. You didn't have a CMBS market. The public capital and the efficiency of that public capital, A, has prevented a big downfall during this, quote, recession that we've just gone through. And B, it has really kept the lid on making sure that a lot of new construction is not occurring and that people are doing good deals with good operators.
Absolutely. No
You know,
question.
That's right. The market is efficient.
Time
That's
is,
right.
you know.
I protest.
Okay,
I think that's, you could look at situations and say
It
yes,
has
you could
happened.
look at a lot of things and say no.
Well, but it has happened. I mean, let's look at the facts.
We've seen far less.
Real estate is
speculative
not the
construction
person
in this
that led us
cycle
into
than
the
we did in the last
recession
cycle.
and probably
No.
won't be the person that leads us
I
out.
mean,
Faults
we
are
don't
way
have that
down.
much construction, but okay, we're getting close to ending of our show. But I think in today's market, we've got a pretty good idea of what's happening. We've got a lender's opinion. We've spoken about different areas. You're saying there's no other buildings going to be built in Lafayette Street, unless they're on the top of a subway. But you know, I think if we had to conclude, I think everyone would say that New York City is a vibrant economy, and even though the effects of 9/11 were there, downtown Manhattan, you believe is going to be there, and I think a lot of people do. I think there's been a lot of buildings that have been acquired for other purposes, a lot of residential. And I think the big question on that relates to what I think maybe Anthony said, you know, you may have other problems. I mean, everybody's...
Hey, just because a borrower loses a building or a lender forecloses doesn't mean someone can't live there or rent it and occupy it for space. That's just...
Doesn't make it a bad building.
Doesn't make it
They
a
might
bad
just
building.
paid too much at the wrong time or financed it improperly.
Someone's still going to be able to
It's
rent
a
it.
hiccup.
Okay,
I
so...
think David and Anthony and Leslie and Rob and everybody here, we have a unique long-term perspective. And if you boil it all down, Germans will come and go, the Japanese will come and
Exactly
go. But you've got a core group of Manhattan real estate investors and operators
and lenders.
and lenders
Right, who will be here
that
through every
take
cycle.
a 20, 30, 40
That's
year
right.
And my comfort level
perspective.
is that these people are sitting here because they have vision, they've done a great job operating, and they've really made the city vibrant.
Okay.
And so that's my comfort level.
I would like to thank all of you for being here today. I'd like to say thank you to Steve Cantor, Global Head of Real Estate for Credit Suisse First Boston, Robert Lapidus, President of L&L Acquisitions, Leslie Woman-Himmel, of Managing Partner and Principal of Himmel Marengoff Properties, Erica Dar, President of Allied Partners, Anthony Malkin of W&M Properties and a variety of other entities, and David Brass of Brass Realty. Next month, we shift our focus and we go to residential developments around the tri-state area. Thank you all, and see you next month.
Funding for the Stoller Report is made possible by a grant from the First American Title Insurance Company of New York. The First American Corporation is the nation's leading diversified provider of business information products and services that impact the major events of people's lives.